In today's video, we take a deep dive look together at the stock, crypto, and commodities markets right now in what is set to be another bonanza week of economic data and of course big news. We're still in earnings in the stock market, we've seen increased volatility, and it looks like things are about to turn around. But as we know, when periods of big fear are happening, there can be opportunity, but there can also be risk. So stay tuned to find some of the key levels that we're looking at as a community together this week. See you soon. So the best place for us to start our weekly discussions of the markets for the move ahead is to get a bit of an idea of where we've come from. And here's the stock market in terms of the large companies in the SP 500. You'll notice here that we have energy and financials not being green for the month. And this is because it's not a broad-based sell-off. Of course, what are the concerns right now? Inflation and interest rates. And I think this is one of the places that we can really find out how fearful or illogical potentially the market is. We do have some big sell-offs in things like Microsoft, Nvidia, Tesla, Amazon, Netflix, just to name a few, but they're all being growth stocks and everything's coming into earnings. So a lot of this is all going to be how do they perform in earnings. We've now seen Microsoft have earnings. It's bounced up heavily since that point. Apple ended up beating the expectation, 6.98% on the Friday session, and everything started to make the switch. But we need to hold back because not just yet have we seen the signs of full recovery. We know that the volatility has been up, down, up, down, up, down 3% almost every day for the last week. And we're coming into the big US jobs numbers and some other key economic data. So we need to see things like Amazon and Alphabet hold up as well before many investors will come back into these markets. And in fact, traders also will be looking at some of these key levels that we'll be finding today. Let's jump into what actually happened through the Friday session, and some important changes happened buying into the close. We know that when Wall Street is selling the close, as in the market's falling after a big rally in the morning, this is where retail is, this is where Wall Street is. And when Wall Street's buying the close, we should be paying attention. During all of those sell-off days, Wall Street sold the close. They literally sold into the buy the dip philosophy that many of us retail traders have. And whether rightly or wrongly, it's unfortunately the manipulation that can go on in the markets. We also saw that there was a big movement, as we know, into technology. XLK was the best performing sector, up 4.37%. And then we had a whole bunch of beaten down sectors like biotechnology, communications, all of these doing quite well. Things like gold suffered due to the US dollar going out of control, and that's because it's starting to price in a faster rate of interest rates thanks to what Jerome Powell said. He basically said, yeah, 3 rate hikes, maybe even more in 1 year. And that's starting to fall in line with this idea that the market just went 4 rate hikes. That's how many we will have. Whether that will become true or not, we don't know yet. Let's move over to the earnings and really talk about what's going on for the week. And it is all about these earnings results. AMD, PayPal, Alphabet, Tuesday after the close. We've got Facebook, the Meta after the close Wednesday. And then, of course, another big one, Amazon after the close Thursday. Once we usually see the FANG stocks or these large technology stocks announce, we get a bit of an idea of whether the market is healthy to some degree. And that's because, of course, these make up 20 to 25% of the market overall. When you have such a huge portion of the market that is really made up of these big growth stocks, you can see why it gets beaten around each way depending on how it performs. So a lot of people are freaking out about the market. They're saying, oh, interest rate hikes, the market's going to go lower, and they're losing sight of the big picture. Here on the channel, we try to bring in data, technical analysis, and of course, some fundamental information to give you a bit of an idea of whether you should be freaking out in the markets or whether there is more calm to be had and you will prevail when you're making better informed decisions. So we know that first rate hikes can create volatility in the 3-month period. We also know that if we came back in 6 months or 12 months, the market tends to actually still be up, green, and have decent performance. We also know that this year is the midterm election year, often can be, and in fact has been in the past few times, a very volatile time. Ever since 2002, really, you've had some really big pullbacks in the markets. And we must remember 12% plus is what we just achieved in the S&P 500. So we started to get down to these really big sell-offs and sell-off levels. The key stat, the next year. We come back a year later, guess what? We're up huge. And it's not just a little bit, it's upwards of 30% higher than where we were. We also know volatility tends to be incredible around February into March. This is thanks to earnings season and that sell-off in technology you generally see. And while we've started earlier here in January, February, and March can be sideways months. So this becomes very important when we're understanding whether this market is just going to go all the way back to the peaks or whether it's more likely to go sideways. The data would show us sideways. The technical analysis may tell us something else. Let's begin by discussing the VIX. This is one of the things that we were looking for to find a base in the markets. This is one of those signs that maybe some of the fear's gone out and we can start to come back in from an investment perspective, from a trade perspective, and possibly even start swing trading very, very soon. Remember, when the VIX is above 20, we need to be careful for swing trading. We usually like to scalp, day trade, and invest in key companies and indices that we like at those points. So the VIX weekly came all the way back down to where it started. So all that volatility coming into the Fed has now stopped. This is pretty normal. We usually don't see the VIX being able to hold these highs for long. And while increased volatility will certainly come in around the jobs number on Friday, just before, of course, the New York Open, we'll talk about that later. This is the type of thing and one of the precursor kind of moves that we like to see to show us that we've found a base in the stock markets. It's step one, let's call it, of being able to find a base. And this is a big key importance. Let's also talk about another thing that's been really worrying people, and that is the yield. What is happening with interest rates? We've seen the US 2-year go up to 1.2% and started to decline. One of the key things that many traders and investors want to see in the market is this to stabilize and potentially even break underneath something that's been holding. So maybe a break under this red line here, the 20 moving average on the daily, would be a big deal to show that the market is less fearful of massive interest rate decisions and it's starting to pull back more in line with the Fed. Remember, the stock market can sometimes get carried away and over exert itself. We call it like the extension phase, and that's where it could be here in the US 2-year. We've already seen a movement in the 10-year. The 10-year's come right back down, 1.9-ish% all the way back down now to 1.773. And you can see here the big key resistance support zone, which will probably be met at around the same point that the stock market would recover. And we'll take a look at the synergies between these a little bit later on. So this is the 10-year, and you can see exactly that support resistance is a key zone we'll be watching. PCC, put call ratios, often people look at this to find out whether there's a lot of fear in markets or not. We know that we hit an incredible level here on the PCC a few weeks ago. The daily went up to 1.3. We've only seen a few times during the pandemic lows and the 18 crash where the PCC has gone higher than that in the last couple of years. So this can often also signify that when huge amounts of puts enter the market, the fear is at the highest, the FUD is at the highest, and the market can turn around when everyone starts to place a position in a certain direction. When everyone gets fearful, as Warren Buffett would say, maybe it's time to get a little bit greedy. And the PCC was showing that it was time to start considering greed at some of the key levels that we saw before the Fed. And many of you probably have pulled the trigger around that 50 exponential moving average on the SP 500. It's a key level. It held, and we know that it's one of those zones that the market is sticky to. It holds that area, and if it gets underneath that, that's when we really need to start being scared. Let's move over to the DXY. The US dollar continues to come strengthening up here. We've got a great trend line that we've seen hold quite a few times, and we've breached to a new peak. So the US dollar may be going into a bit of a revaluation here. They've said that they're going to rate hike 3 times. Obviously, this has now become the truth to the market, and the market's getting ahead of itself and saying, okay, even more interest rate hikes to come, 4, 5, 6, 7, how many can we have? And it's pricing accordingly. The next stop could be upwards of 100 here for the DXY, and this poses a bit of a problem for gold, silver, platinum traders. Everything was looking pretty good coming into the Fed decision. The Fed kind of changed the playbook a little bit, and when they did that, it smashed gold around. Unfortunately, it was always one of the risks. Many people would know we like the 1830 level, and the 1830 stop losses would have got absolutely hit during this session, and now we're all the way back down at this annoying trend line that we were all those months ago. So very unfortunate. It's because of the DXY. And of course, now that we've seen that fear coming out of the market to a degree and interest rates going at a faster pace, it's put pressure on something like gold, which is often seen as more of an, I guess you would say, like a hedge versus some of the growth opportunities. Let's move over to US oil. We will talk about gold a little bit later on in terms of the next week as we get more clarity. It's just sitting on support and we can't do much about it. Let's move over to here though. US oil, long leg doji, indecision candle. We've got the open, the close, the high, the low. Many people would know this is one of our big candles showing us that it's maybe time to just chill in this particular position. We know that we like this idea that oil goes to $92 after a breach past that 85, but it is saying, well, we're slowing down at this stage. We'll look for a break close above these levels here. And once that occurs, you would think oil is going to be quite strong towards the 92 resistance, which is previous support all those years ago. This is a key zone. Oil is starting to get to that toppy kind of area. It may go into a super cycle where it returns back to really big levels, but for now, traders really rule oil. And we've got to remember OPEC and all of these types of, I guess you could almost say cartels, really control the price here. So it's better to be nimble, fast, and quick when it comes to oil. And while the recovery is still looking strong on the weekly, we need to check those dailies. Close above the long leg doji would be key. Let's move over to semiconductors. This is our sector of discussion for the week ahead. And the reason why? Well, of course, it's on huge support. So we have the previous trend line lows here. We have the previous resistance sitting around this 260, and that's exactly where we've closed. For anyone that's interested in semiconductors, they've pretty much been the only sector that has completely obliterated any other sector for well over a decade in performance. And you'll notice it's come down almost upwards of 21%, and it's still down around 18.5%. To put this in some clarity, and this just shows you how much overperformance this particular sector's had. If you invested over here in 2015, you can see it was about $60, and now this is around 261. So semiconductor index has beaten pretty much everything else. It's done incredibly well, and it is at that key level of support. Now what we look for is we look for the turnaround story, and we've already seen the first signs of it. So the first signs of it are bullish hammer, bit of indecision, another bullish hammer, and a breakthrough of that peak. This is kind of, for many people, showing us there's a bit of a base here for semiconductors through that session. And of course, the big trigger fingers for a lot of people are going to be around that 275, where the previous resistance would get knocked out, and we would be saying, okay, look, we've accumulated at the base, we've made a decision, and that would usually be accompanied by some kind of move like this, which is what we call the lightning bolt. The trough, the peak, the higher trough, and then the higher peak. We'll look at a lightning bolt a little bit later on the SP500, as there's a very big key one. Move over to Tesla. So disappointing the way the market reacted here. For Tesla, people that have been looking at the fundamentals, they might still be believing very hard in the stock. Maybe they like exactly what came out and they think the stocks or the stock market's being irrational. From a technical analysis perspective though, it's not really a joke level. I mean, what's just happened is it's hit the 50 exponential moving average, which is where it came to the last 2 times that it dropped, and it bounced off this area. It is imperative that Tesla holds this zone. If it cannot, you'll notice that in the 2020 crash, it held, and also in the 2021 crash down, it held to the 50 exponential moving average, this blue line here. It came all the way down to $800 and then bounced fairly hard. It's back at $846. If you like investing on this particular stock, you could really see why people are getting excited about it here. It is underneath our trend line. It did manage to bounce pretty much to the bottom of it again. It's not out of the woods just yet. It's more at a very key weekly level. If we go down to something like the daily, or we go down to the 1 hour, what we're looking for here is the turnaround story. And you'll notice it's beginning to start that little small lightning bolt. We've got the trough, we've got the peak, got the higher trough. Do we get the higher peak and break out the previous support, which has become resistance? That's at around that 860 level. I think day traders will be very much looking around there through the Monday session and Tuesday session, and it's certainly one to watch. We'll watch Tesla quite closely this week. We'll move over to Apple. Apple came out with its earnings announcement. It ended up beating expectations, which is actually a surprise to me. I thought that maybe Apple would suffer a little bit here in this earnings, but the big FANG stocks continue. Apple was certainly my least picked one. I would have gone with the Microsoft in my case, or the Google to potentially do really, really well, or even Facebook. But Apple has done incredibly well here, and it's come back and it's got 170. This is kind of like the heartbeat of the growth stocks. If Apple suffers, the rest of the stocks tend to get driven down sentiment-wise. So it's definitely a big move here. Very untechnical what it's doing at this stage. Obviously, it's busted through previous support, becoming resistance thanks to the fundamentals. And we'll have to come back to this as we get more clarity through the Monday and Tuesday markets. Let's talk about a big earner from the FANG, which is the Amazon. And as you know, Amazon has had some really big troubles recently with the stock. Many people, big high profile people, have been selling this stock and saying it's all over, and they believe it's going down. People have been protecting especially hard into the earnings season. So we've got here support. People are starting to lose the faith. The market, as you can tell, is finding as much buying pressure as it can around this area. You basically have that 2900 res. So the 2900 res ahead of earnings, and you have that support sitting around 2750. And we're stuck in a range or a channel between those levels. If we breach past this, could be a great opportunity coming off earnings. Obviously, that will be the discussion point. And there's a lot of risk here. A lot of people will be playing options into this because they try to take away some of the risk going into the big earnings announcement. But you can see what's at stake. This support is a big deal. It's held up since July of 2020. And if they have a bad announcement, unfortunately for Amazon, it could be very bad. So at this stage, I don't think it will be. But this is the type of thing that's at risk. You can see the technicals. Many times people don't understand that the markets tend to come into a key level of support or a key level of resistance ahead of big announcements. Why was the stock market sitting on a 50 exponential moving average ahead of the Fed? Because it's the best key point of support or resistance, in this case support. If it had breached below, many algorithms would have gotten involved in the markets. Remember, that's a big top tip. If you don't really realize this, that most of the time before an announcement, there will be a key resistance or support being tested ahead of that, depending on the sentiment. Let's move over to the major indices now and talk about some of these stock market moves. So we're all aware that IWM, the Russell 2000, still looks quite sick. We've got here the Wyckoff, obviously the Max Payne idea. This is the Wyckoff distribution, and this did breach underneath the 210. Now, this market has not shown us the stages of recovery like we're seeing in the Nasdaq or SP500. And I think it's kind of showing us whether there is a longer term growth curve or longer term health of the market coming up and out of this pullback. We'll be watching IWM quite closely, but it's not the chart of the week. The chart of the weeks begin to become the Nasdaq and the S&P 500. They're showing some amazing levels. So let's start here with the Nasdaq. The Nasdaq is literally hitting the 50 exponential moving average on the weekly from the bottom up. It found resistance at that level. It becomes very clear that 14.6 is a key zone. You've got previous supports around that area. You've got resistance here on the weekly, and you've got a bit of an indecision candle. If we go into something like the daily time frame, you'll see the stabilization of the Nasdaq. Sells off, buyback, huge volume through this day. Then of course the Fed near the close, Jerome selling it off pretty hard. And then we move back up in the Friday session. 14.6 becomes a very key zone for us to breach through. And if we can, we're starting to put in place the building blocks of a great recovery. But where I'm most excited has to be the S&P 500. Let's break this down in a deep dive right now. Firstly, we hit the 4,200 almost perfectly. Then we bounce back up. We've hit a resistance at around this level here, that 44.50. We've sold back off a few times, and then we've bounced. What is that starting to look like? A trough, a peak, a higher trough, and then a higher peak. The great thing about lightning bolt turnarounds or a proper technical turnaround is that it's usually well thought out and considered in the markets. And while everyone's freaking out about things, let's go back to the top down. Let's go back to the weekly. The weekly hit the 50 exponential moving average. It hit a 4,300, which was our key zone, and it went even further to a monthly S3. That's a monthly S3 pivot. It's not like volume isn't here. There's huge volume transactions going on through the week. So the markets are considering it. But I think we need to go back a little bit to previous times to get a bit of an understanding whether we can trust this current move. So we know we're at resistance, daily 200 moving average at the resistance. We know all of these big lightning bolt things, the key level of support and everything. But this is kind of common with these pullbacks and high volatility. Here in 2019, we saw something similar. Huge bounces, breakout, and we got that secondary dip. Notice the secondary dip, very important point here. Then we go back over to another point of incredible volatility, 18. Many of you guys have studied this one. Supports, resistances, doesn't quite breach through, and then all of a sudden sells off, lightning bolt. That was the beginning of that big upward trend. So in this case, we didn't really see a secondary, slower recovery followed by another dip. But again, big channel, big volatility. Over here, big channel, big volatility. What looked like a breakout, it certainly was, and then it came back down. There's often this double dip phenomenon that occurs here after such huge volatility and big range. So we've got a channel very similar to previous times in 18, in 19, and all these previous times. But we usually do see either a new low being formed, or if it does break through, it comes back and gets people. So I think that's something that we will need to consider and think that is going to happen this time around. We get that secondary pullback. What do you think in the comments? Do you think there'll be a secondary pullback? Do you think there'll be a V-shaped recovery? Let's say we do breach out from this peak here. Do we move all the way back to all-time highs, or is it more likely through this unstable period, this February-March period in the Nasdaq and the growth stocks, we see something like this, sell off, maybe a continuation, and then we have that, of course, eventual growth in the markets? Is that a more likely scenario? A lot of it comes down to this week. Remember, we're at a key level of resistance. If we breach it down to something like a 1 hour chart and we start looking at the charts, you will notice 44.50. What a level. Resistance, big zone. Huge interaction. Day traders are going to be looking all over it. Some sellers will probably come in here. It's going to be a big one. So make sure you subscribe to check out our channel, as we'll be covering this as much as possible. Another big one before we get into the economic data coming out is Bitcoin. And this is a tough market to watch right now because of its current sinking a little bit with the Nasdaq. It's bounced back after the Nasdaq fell. Obviously, it's found some buyers. We're in Chinese New Year, or about to start Chinese New Year. Now, that's an important factor. Chinese New Year can lower the volume transactions in the crypto markets and then create maybe a little bit of instability, something to be watching for. But the market recovery here for Bitcoin hasn't been that extreme sharpness that we used to see where FOMO came back in. We saw that huge rally. It's been more considered. Last time, the buyers really didn't rip the market. Over here, the buyers are kind of buying it up faster, but not that much more. Still got 40,000 as a big key resistance that we'll need to break. Bitcoin's just showing itself to be, I guess, stabilizing at this point. It's the same with Ethereum. The recovery to 3,000 is not quite there. We're breaching up. Signs are looking good, but not as good as they have been in the past in terms of speed. Let's check out the calendar and have a look here. A lot of things going on. I mean, we've got ADP, non-farm employment change information coming out Wednesday. Obviously, the JOLTS, job openings, ISM manufacturing for the Tuesday session. And then if we scroll down, the big one for this week is, of course, this one here, the non-farm employment change numbers, 8:30 a.m. New York time. This bit of data probably going to shake the markets quite a lot. It's going to dictate a lot about what people believe is going to happen with interest rates in the future, what the Fed might be doing. And while they're not combating necessarily the jobs numbers, remember one of the Fed's main things to do is to make sure that unemployment is continuing to, of course, drop here and we get a huge amount of employment. That's what they want to reach. And of course, they've got their inflation goals as well. Thanks so much for watching. If you enjoyed our video, please remember to subscribe, smash that like button, and we'll see you throughout the week for the streams and, of course, our daily videos. Have a great one. Bye for now.